The fall stretch for stocks and whether the Fed just gave the green light for more gains ahead. Let's ask Rick Rieder. He is BlackRock's CIO of Global Fixed Income, also the head of the Global Allocation Team. Back at Post 9. It's good to see you.
Good to be here. Thanks.
It's nice to see you, especially after what the Fed did last week. So what's your big takeaway as to how the market's reacted since?
So, by the way, I find it interesting, the difference between the bond market and the stock market. The bond market is actually backed up. I mean, we've, should we follow these short forwards, what they're pricing in for the Fed? They backed up almost 20 basis points. 10 years come off, rates higher by about 10 to 15 basis points.
Why? Why is that?
Because we were pricing in a recession. If you go back a week or two ago, I mean, this extraordinary movement towards pricing to recession, hard landing recession, and the fact that the Fed was behind and would have to get there, it was too much. That being said, I think we've retraced to the place that's probably okay. I always get a kick out of that, where the bond market, people say, well, the equities are rallying because Fed's moving. Well, the bond market already knew, it was already in the price that they were moving. Listen, I think one thing that's a big takeaway is when you go 50 and you talk about we're willing to keep going and you talk about a recalibration they needed to do, is a little bit of we put foam on the runway. The Fed is receptive. Now that inflation, we're running 2% by many measures, under 2%. You got a Fed that'll be sensitive to the economy, sensitive to labor. So that's good. I mean, is that a positive for equities? 100%.
How far and how fast do you think they go from here?
Listen, I find equities just okay, not great. I mean, for years we
talked about... I meant the Fed, but you could talk about equity. Go ahead. Well, given what you said in the first answer, why do you just see equities as okay? That's somewhat surprising given what you said.
So the best way I value equities is I always look at cash flow discounted by the cost of debt. Today, the cost of debt is still elevated because of where the Fed is. And then if you look at multiples, it's just not. The equities aren't that interesting. You're still throwing off good return on equity. 18%, 19%, but you're trading at price to book of 5 times price to book. You're paying a lot for it. You talk about 24.5 times PE off of trailing, 21.5 off of forward, but that's assuming 15% growth of earnings. You're just paying a lot. And you think about for the last couple of years, extraordinary top line revenue growth from tech that motivated the market higher. Listen, I think the numbers will continue to be good, but the market's pricing that today. So they're just okay. If you said to me, I did a presentation called Moving the Needle, would I buy more yielding assets? I definitely would buy more yielding assets because they're at better price than equities today.
Okay, so you've made the remark in the last few weeks that you think it's a golden age for fixed income.
Yeah.
As a result of that, I always am out with Jeffrey Gundlach. We speak with him for Fed Day, and I asked him about that, and it's not like he disagreed wholeheartedly with he's fixed income, obviously does well.
Yeah.
But he said, I think you have to be extremely careful with your positioning on that. So can you elaborate on why you think it's a golden age? And do you need to be more careful or more specific as to exactly where you look?
So I've been doing this a really long time. It's very, very rare that you have inflation running at 2% and actually trending a bit lower, that you can buy assets that yield. And by the way, not really risky assets. You can use securitized assets. You can use higher quality, high yield. You can create a portfolio to 6.5. So your real rate of return or your real rate of interest is very attractive. At the same time, listen, you always have to be careful in fixed income. I mean, the upside of fixed income is we get our money back. You always have to be careful. Today, you think about during COVID, what happened? Companies termed their debt out. They pushed their maturity wall out. Individuals they blocked in their mortgages. It's pretty rare that you get those sort of yields, those sort of real rates. At the same time, there's no maturity wall in front of many of these companies. That's pretty good. It's pretty hard to default if you don't have debt coming due. And most companies don't have debt coming due. So, listen, I think the environment is great. Do you be careful? Of course, you always be careful. How much emerging markets do you need to own in the portfolio? Maybe not a lot today because there's yield everywhere. But gosh, I mean, you can build a diversified portfolio with a lot of yield today, and I think that's super attractive.
Wow.
Relative to equities, that valuation, it's been a couple of decades that you had that sort of divergence between the earnings yield of equities and the earnings yield of, or the yields you're getting on bonds.
So the real bull market now, the next major leg of it comes in fixed income, not stocks.
So by the way, last week, it was pretty, I was busy yesterday. It was a pretty ferocious rally in credit. I mean, spreads keep tightening and tightening. The reason why they are is people have been sitting in, the trade the last couple of years has been, I'll sit in cash and I'll buy NVIDIA. And or maybe I'll get 6 more stocks, diversify it. Now it's like maybe my cash level is going to come down. The yield on cash will come down. Maybe I'm not going to get this explosive growth in earnings. How do I lock in that yield for the next 3 years, 4 years, 5 years? So, listen, I think that will continue, and boy, it's pretty impressive in terms of the flows that are driving that.
Why don't